To the Stockouts. This is your show at FreightWaves about CPG industries, those are consumer packaged goods and their supply chains. I'm your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves. And in addition to doing things related to rail and intermodal, also follow the consumer packaged goods industry. And every Monday, we set aside 26 minutes to go through what I think those shippers in that very big industry want to hear about. And what I have for you today is I'm going to talk through Constellation Brands earnings, which reported last week. It was a little bit of a controversial quarter, and I think there's some trends there that apply not just to Constellation, not just to beer and alcohol companies, but also sort of the broader consumer packaged goods companies. So I'll talk through some of those. And then we published a number of articles on FreightWaves.com that I think really hit on various topics that CPG companies want, are going to want to hear about. That they're going to care about things like truckload carriers' tender acceptance rates, warehousing prices, supply chain, finance. Todd Maiden wrote up an article about that, and then railcar lease rates. I can talk through. Greenbrier reported last week, big railcar manufacturer. I can talk a little bit about what they said and what that means for any companies that are leasing or trying to acquire rail cars. So, with that, I'll get into the first topic, which is Constellation Brands experiences continued margin pressure. So Constellation Brands, we don't know who they are. They are the company that manufactures Corona, Modelo, various wine and liquor. Shares were down about 10% on Thursday. That was the biggest one-day decline since March 2020. You can see on the right part of that stock chart. That's a Constellation Brands stock chart. Ticker STZ, fell about 10% right there on Thursday. So, had been so close to 52-week low at this point. And some of the things they talked about was inflation cutting into beer sales. They tend to target a little bit of the higher, end market, maybe the premium beer market with Corona, Modelo, et cetera. That's maybe a cut above what you would get from a Budweiser. And one of the key stats here is the number of cases they sent to distributors increased 5.7% in the quarter. And that's been a slowing from 8 to 9%, which they've seen the past few quarters. Some of the investors like this stock because it has revenue growth. I mean, there's only so much earnings growth you can have by cutting costs. At some point, you need to sell more beer in this case, which in generally they've been doing. And Modelo specifically, they said their growth was 4%. Which compared to 10% in the prior quarter. So still, seems like they're growing the volume, growing the sales, just at a rate that is less than they had been doing previously. The company also said there's going to be continued margin pressure, which I think is something that we're going to see in other CPGs as well. Of course, they've gone through a lot of margin pressure the last 2 years and sort of hoping that at this point we're starting to get out of it. But you listen to a comment like Constellation Brands, and they said they have they're expecting 8 to 9% revenue growth and 4 to 5% operating income growth, which still positive numbers, but sort of does imply some margin pressure there. They said the margins are going to be below targeted levels. I think they said operating margins tend to be about 40%, 39 or 40%. They're going to think it's going to be more like 38%. And some of the things that they called out specifically are so the raw materials still higher. They do hedge about 10% of their beer costs, and so it does take a while for some of those hedges to come off, even as the commodity prices go down. Packaging still inflationary. They talked about packaging products like aluminum and glass. Those have come down from their highs, still above pre-pandemic levels. Logistics costs are still relatively high for them overall, even though we'll talk about why I think some of those should come down. And then one area of cost that I like that they're doing is brewery expansions and marketing. And I think part of the idea is that this company with Corona and Modelo, they do very well with Hispanic consumers. They do very well in California and kind of the West Coast, trying to push that, to more of a nationwide sales. It's a little bit more widely, maybe widely distributed, or more of the sales is more proportional to the population is maybe the better way to put it. So making some big pushes there, and that could impact near-term results, but those are probably worthwhile investments longer term. So bottom line with Constellation is I think there's a limit to the amount of pricing consumers will take. It is interesting how they describe the pricing of beer, where they increase the price, somewhat, and they, see how the consumer reacts to that. Let's say they increase the price 4 or 5%, and volumes, drop, and they'll back off a little bit on those pricing. So even though you tend to think of, alcohol as being something that's not cyclical, something that consumers don't cut back on, I do think there is some trading down. And they said they have had six consecutive quarters of market share gain. So that's one of the things that investors do like about the stock is that market share gains. There was some controversy in the analyst Q&A session where a lot of the analysts were comparing their data to the data from some of the industry data sets that are out there in terms of retail sales, things like Nielsen, things like IRI, and they sort of thought that their sales were disappointing relative to those trends. Company insists it's still taking market share, but we'll sort of see in the coming quarters with Constellation Brands and their brands Corona and Modelo. So some interesting things there, I thought. Moving on to topic number 2. Tender acceptance at an all-time high level for the holidays. So there was an article that Zach Strickland, my colleague, who is the head of Sonar, or head of market intelligence, I guess is his title, wrote a good article sort of talking about what's taken place with the tender rejection rates. Have a chart on the tender rejection rates, which in 2022 into 23, where we are today, is that white line, and carriers are only rejecting 5.1% of tenders. And so sort of flip this around, how a CPG company or a big shipper would look at this, and they tend to think of it as a tender acceptance rate. So about a 95% acceptance rate. Put out 100 tenders, carriers on the contract market accept 95 of them. That's a good place to be, and not having that tender rejection rate increase above 6%, or not having the tender acceptance rate fall below 94% over the holiday season was an indicator that the market is loose. So typically over the Christmas season, whether it's a tight market or a loose market, you do see increases in the tender rejection rates. And you saw that in that 2019 period in blue there, where it went from about 7% to about 14%. And you also saw that in 2021 into 2022, where it went from about 22% to about 23% from a higher level during the Christmas season. So really didn't see an increase to the same extent. And we think that that's really an indicator that truckload capacity is loose, and that loose truckload capacity will go from what's typically a seasonally tight market, which is right around the holiday season, to the January and February, which is usually the loosest market seasonally for truckload capacity. Truckload capacity doesn't usually tighten up until about March, where some of that early summer merchandise starts to ship in March. So like the truckload carriers, their first quarter does tend to be dominated by what happens in March. But this month and next month, expecting transportation markets to be fairly loose. And I think the question becomes is are we going to see a typical seasonal tightness in March? Didn't really see it last year. In fact, we saw loosening during March, where typically you would see tightening, and that caused a lot of our prognostications at FreightWaves, talking about how we expected the truckload market to loosen, and I think those things really came to fruition over the course of the year. Now, in this article that Zach Strickland wrote on Saturday, Chart of the Week article, also talks about how these loosening freight markets are somewhat of a double-edged sword for shippers. Yes, it's easier to find and source transportation capacity, but a lot of that is because the sales are down, inventories are too high, the consumer is slowing down. What I would add to that is that CPG companies are in a better place as far as their sales go. CPG, kind of the last thing people cut back on. Really, what's in a tough spot in terms of sales and demand are sort of what we call general merchandise, which would be things like hard lines, which would include furniture, a lot of clothing. Clothing are soft lines, but things that are more discretionary in nature. CPG, doesn't have the same degree of high inventories. In fact, a lot of the retailers are still working to build up their CPG inventory. So they're in a little bit of a better place where CPG demand, yes, talked about how demand is maybe slowing a little bit for a company like Constellation, but, still growing, and for the most part, in a much better spot than most other consumer goods, companies. I also want to talk a little bit about how that translates to freight rates going forward. Have a chart on van contract rates and comparing those to the spot rates. And so the van contract rates, if we can get that next chart, pulled up, you can see that the contract rates are in white and the spot rates are in orange. The van contract rates in white exclude fuel surcharges, and the orange rates, which are the spot rates, those have undergone a mechanism to remove the surcharges because fuel is included in most spot rates, and so this is kind of view this as an apples to apples comparison. Spot rates above contract rates up until about March of last year. And then they've been lower ever since then. And you see right around the holiday season, spot rates increased from about $2 a mile, excluding fuel on average, to about $2.25, and have come down into about $2.21. And so that spread between contract rates and spot rates, where the contract rates had been higher by a whopping roughly 70 cents a mile, they're still higher by about 50 cents a mile, still not sustainable. And we view this as something that's going to cause the contract rates to come down in the coming quarters as more big shippers rebid their freight for the upcoming year, which a lot of those bids take place in the early part of the year. So still pretty wide gap there, and shows that contract rates have further to fall. I'll move on to topic number 3, which is changes in supply chain finance rules could impact shippers. And so this was an article that Todd Maiden wrote, who used to do what I used to do, which he was a sell-side stock analyst, just like I was at a different shop. And he wrote this up, sort of leveraging his expertise with accounting and financial statement analysis. And so he's talking about supply chain finance or reverse factoring. And what that is it allows the buyers of transportation services, so shippers, to utilize that full payment window. Let's say it's 30 days, let's say it's 60 days, maybe it's 90 days, and sort of push out when they pay carriers, but it also allows the carriers to get paid right away. And so the bank is the one providing that financing. And so the bank is basically buying the receivables that is an asset for the carriers, and is paying a discounted rate on those receivables in exchange for making that payment quickly. The shippers make the same payment; they just make it later on in the future. So both carrier and shipper roughly get what they want, which is to maximize the available cash flow in the near term. And what's changed that Todd describes in this article is that there's been an update to the Financial Accounting Standards Board rule on December 15th, where there's additional disclosure that needs to take place. And the idea is to provide additional transparency to the liabilities that are not on the balance sheet. So, for instance, a shipper doesn't have to pay for 90 days their freight costs because of this reverse factoring program that the bank is allowing. Well, they have to disclose that and sort of what the terms are. And so there's also speculation that the financial institutions will stop providing this type of financing, and that could have a big impact on sort of the smaller carriers that are not as well capitalized as some of the bigger carriers. A lot of those smaller carriers rely on that factoring because they need that cash right away in order to make the payments on their trucks, in order to pay for the insurance, in order to pay the drivers, all of those things. And it could hasten the exit of capacity if banks were to say, well, some of the shippers that are paying us 90 days later. They're not great credit risks. I don't know if I want to front the money, for that. And then all of a sudden, carriers, won't be able to get paid as quickly. Maybe they won't get paid at all if those shippers are bad credit risks, and that could lead to an exit of capacity in the industry. One of the companies that was called out as actually using this is Ball Corporation. That's a company that makes aluminum cans. Would consider them a good credit risk, but nevertheless, shippers that use this may have it less available to them. So just something to keep in mind if you're a CPG company and have to do this. It might add a step, or might have to have a more dramatic change on how you pay for transportation services. I'll move on to topic number 4, which is warehousing market continues to cool. So have a chart on Logistics Managers Index for warehousing prices. And this shows that warehousing prices, according to LMI, peaked right around March of last year, which I feel like I've said March a lot in this presentation, which really was kind of a turning point in a lot of different ways. A warehousing market has it included, in fact, in last March, looked at what we were writing about warehousing on FreightWaves.com, and we wrote an article, and it was Zach Strickland who wrote this article also, citing warehousing prices hit a new all-time high, and now here we are in January of 2023, and the evidence suggests that warehousing prices are very much going the other way. We heard this expectation late last year from RJW Logistics Group, who sponsored this show in, I want to say, September and October. And their CEO, Kevin Williamson, was warning that we're just building way too much warehousing capacity, that it's, went from having too little warehousing capacity to building, too much of, and they would know because they consolidate shipments on behalf of CPG companies. They run it all through their big, warehousing facility that's centralized in Chicago. And his prognostication seems to be coming to fruition here. There's some interesting quotes from a Wall Street Journal article late last week, said that companies, this is according to Cushman and Wakefield, that's a company that does real estate services. They said companies leased 132 million square feet of industrial space. And that's down 28.2% from the third quarter. So big drop there. And then the vacancy rate only ticked up from 3.1% to 3.3%. Mind you, it was about 5% before the pandemic. So it's not like there's a tremendous amount of vacancy yet, but shippers are not willing to pay up in order to secure more space. And really the issue is the amount of new warehousing space that is under construction. And another interesting stat from that article is that 83% of new space is being built without tenants, kind of what you would call building on spec, sort of build it first and build it and hope they will come. And I think a lot of that space is going to be empty in the coming months and years when it comes to fruition. So you could have a situation, let's say a year from now, where warehousing space is really inexpensive. I'll move on to topic number 5 here. Railroads ask courts for a review of new rate dispute rules. This is something that I can talk about in our show later this week. What we call PSR, People Speaking Rail, which I team up with Joanna Marsh on. And basically, the Surface Transportation Board implemented a new rule for small shippers to dispute rate cases. So, railroad shippers, that only can use one railroad, call those captive shippers, have a hard time, contesting rates, have historically, because it's so expensive and time consuming to contest a rate case. That's why it's almost never done. So the Surface Transportation Board implemented a way, and they said either all of the railroads can agree to have arbitrated decisions for small rate cases. That's defined as a dispute of up to $4 million over 2 years. Or if they don't all agree, what's going to happen is final order arbitration, which is the baseball style arbitration. So what would happen under that scenario is a shipper provides their best and final offer, and the railroad provides their best and final offer, and an arbitrator would pick one or the other. And the railroads don't want that. I think that's pretty clear, even though that's what they do in Canada. But it's likelihood that the railroads are going to agree on the arbitrated decision. Not the final order arbitration, but just a regular arbitration, because that wouldn't make those cases public, and so you don't want to open the floodgates to more rate cases. So we'll see. On that, but it seems like the railroads are trying to drag their feet and extend out the timeline for when these rules get fully implemented, so there is not a tremendous number of rate case disputes this year. So that's something that any CPG that moves anything on the railroad, I think is going to want to be, aware of, maybe with the caveat that anything intermodal is going to be excluded from those rate cases, because that's deemed competitive with the highway. But anyone that's moving agriculture inputs, I think are going to want to be mindful of that. Which leads me to the last topic today, is that railcar lease rates are likely to remain high. Other thing that grabbed my attention last week from a stock price movement, in addition to Constellation Brands, was Greenbrier, which had shares down 18% on Friday, and so dug into that a little bit. And they still say that the demand for newly built rail cars, for leasing rail cars, is still strong. And, sort of all that decline was related to input costs rising, things like material shortage, high costs for, outsourced parts, lingering supply chain issues, all of those things. They did say that they're shutting down their Portland facility, what they call the Gunderson facility. But what I think is important for, shippers is that, this business is maybe becoming a little bit less cyclical. The railcar manufacturing business is, and the companies that manufacture the rail cars have gotten to be bigger in leasing, and Greenbrier is one example of that. And so the manufacturers have much, more incentive to not overbuild the rail car fleet in order, because that would ruin their leasing business. If they manufacture too much, then the lease rates would come down. But from what I'm seeing in the rail car leasing market, the industry is going to be pretty judicious about building rail cars this year. I've seen some prognostications that new car delivery is going to be about 45 or 46,000 cars this year. That's roughly in line with replacement rate. If you think about 1.6 million cars, and it's a 40-year lifespan, and there were more than 50,000 rail cars retired in the last year. Now, some of those cars were obsolete. They're things like old coal cars that have an old design. But for the most part, utilization is pretty strong, and there's not a lot of rail cars in storage, maybe with the exception of small cubed covered hoppers, which were overbuilt in order to move frac sand, and general purpose DOT 111 cars, which I think are obsolete based on the current safety standards, as would have to be retrofitted with the latest safety standard. But lease rates expected to increase pretty much across the board. And Greenbrier was talking about having orders to build new rail cars that extend out into 2024. So it's not a situation where the rail car buyers can get a car very quickly, unless they're really a good buyer. Sort of in my experience following these companies, is that when backlogs are long, lease rates tend to be high to lease rail cars, and tend to stay high, because there's just not as much competition. If I'm a shipper and I want to lease a rail car, then the manufacturing is not as much of a competition if those manufacturing backlogs are out a number of months. So that's something that could cause continued logistics costs for some of the big shippers. And so those are really kind of the issues I wanted to go over this week. For anyone that does anything related to the railroads, I would encourage you to check out the new show that I just launched with Joanna Marsh. It's called PSR, or People Speaking Rail, which takes place on Thursday at 3:00 Eastern time. And what we typically do there is go through the articles that Joanna has published on FreightWaves.com, and I can talk about what I'm seeing in the intermodal data. And so the idea is to have 26 minutes. There's the graphic there. It was a great job by our production team to pull that together. You see the people speaking rail on a box car. And so kind of the idea is 26 minutes. Anyone who ships rail, involved in the rail at all, gets everything they need to know in that amount of time. So with that, hope everyone going to have a good day, and would encourage you to sign up also for the Stock Out newsletter for those interested in CPG companies, which you can do at www.freightwaves.com /the stock out. It's under newsletters, and it's the first one there under supply chains. And while you're there, maybe go to freightwaves.com /subscribe and see what other newsletters are relevant to you. And that's really all I had today, and hope everyone has a great day.